In this episode of the MSA rental market update, you can see that we are looking at Montgomery rental market for multifamily properties. This is the capital of Alabama. You can see it sits between Mobile and Birmingham on I-65 and between Mobile and Atlanta between 65 and I-85. We have Tallahassee down here, which we did yesterday. We've got Nashville, Tennessee up here, Huntsville, Jackson, Mississippi, and New Orleans and Jacksonville, Florida over here. So that gives you an idea of where this metro sits in the state of Alabama, almost dead in the middle. So as usual, let's go take a look at our filters and see what we are excluding. We are excluding all corporate, all military, all senior, and all vacation, and we are including only market and market affordable so that we are looking only at conventional apartments. Now, this is a little bit of a low-income market, so if I click affordable here, you'll notice that we change to 260 total properties. So there are a lot of affordable components to the Montgomery area, but we are only looking at conventional apartments for our data sets in this series. If we go to location, you'll see that we are in market, metro statistical area, and Montgomery, Alabama. So let's go take a look and see what the analytics tell us for this metro area in the capital of Alabama. Here is our supply snapshot for Montgomery, Alabama. You can see there are 216 properties in this metro statistical area, totaling 21,015 units. There are 127 units under construction, and over the last 12 months, 572 more people have left the rental market than have entered the rental market. And in 2021, we increased the rental market by 47. And the vacancy is an indication of that. It was at 8.1% a year ago and is now at 10.9%. We did get some increase in market rent per unit from $928 to $951 year over year, but we will see what it looks like on a quarter over quarter basis. Once again, we are not looking at the capital markets. We are only looking at the supply side data, which is our rental market. If we come down to the long-term occupancy average, we can see that the long-term occupancy average is about 89.49% or 10.5% vacancy, and it is currently sitting at 89.12%, so below the long-term occupancy average. One could argue, because it's only about 37 basis points away from each other, that it literally is sitting on the long-term occupancy average as we sit right now, threatening to enter the recession phase. And with vacancy increasing and these absorptions going negative the way they are with units still under construction, that tells me that we are between oversupply and recession in the current market cycle. But let's go look at our data and see if the data confirms that for first all three asset classes, A, B, and C, and then we'll look at each individually. So let's go take a look at our data. So here is the data analytics for the Montgomery metro statistical area in Alabama. We can see that we will not be looking at asking rents. Again, that is what the ownership is asking. We only care what they are collecting. So we'll be looking at effective rent. In the first quarter of 2022, it was $934, went up to $948 in the second quarter, up to $959 in the third quarter, and then down to $937 in the fourth quarter. So the fourth quarter is actually lower than it was in the second quarter. One could argue it was almost equal with what it was in the first quarter. So some slight increases going up and a heavy decrease going down. Let's see what the deliveries and absorption is telling us. So we can look and see that there was a small building, 10 units delivered in the first quarter, and it went negative 103. As a matter of fact, we're now 6 straight quarters, 7 of 8 quarters in negative absorption, even through 2021, which was supposed to be a really strong year in the Montgomery market. So The Montgomery market doesn't look like it's holding its stabilization very well and is already declining, primarily because this is a government market. There's a lot of workforce jobs in this market, a lot of government jobs in this market. There is a car plant, but that car plant is stabilized. Kia has been there for 15 to 20 years and has not grown in that period of time. So we are seeing some decline happen here in this rental market. I don't know if it's people moving out or if it's affordability. My guess is at that high of a rent, it could potentially be affordability. We'll see what the C's and B's tell us. My guess is A's are going to definitely struggle, but I have not looked at it, so we'll see when we get there. So as we sit right now, we are definitely showing this market in decline for all three asset classes, but let's go see what the A's are telling us. So here is the Class A rent analytic data. There are 9 properties totaling 1,513 units. On the effective rent, we started at $1,302, went up to $1,331, then down to $1,309, and then down to $1,280. So we're actually at less rent in the fourth quarter than we were in the first quarter of 2022. So let's see what our deliveries and absorption is telling us. So we had no deliveries in this market, and remember, there are few properties here, only 9 properties totaling 1,500 units. So we can see that we're negative absorption in 4 of the last 5 quarters. So same story it's telling us as before, where we're seeing a lot of exit or the renters in the market leaving the marketplace. Again, small numbers, but still negative nonetheless. It's not absorbing, it's going the opposite direction. And we can see that where we were at 97.7% occupancy all the way down to 95.9 by the time we got to the fourth quarter of 2022. So A's is telling a similar story. Let's see what the B class is telling us. So here is our Class B rent analytic data. There are 69 properties totaling 8,987 units. Looking at effective rent, we can see we started at 1061, went up to 1073, up to 1088, and then down to 1055. So once again, we had small increases through the third quarter and then a large decrease going into the fourth quarter, where we are now lower in the fourth quarter than we were in the first quarter. So if we go over and look at our deliveries and absorption, our 10 units went to the Class B space, and we absorbed more than what were delivered, even though there was some catch-up needed from the previous 2 quarters. So once again, we've got 5 out of the last 6 quarters that are negative absorption. Of course, after the 28 absorbed, it went completely negative from there. We were at 94.1 in the first quarter of occupancy, down to 92.7. So Class B's telling us the same story the A's are telling us, that the renters are no longer willing to rent in this market. Either they're moving out of the market or the rents are too high and they're doubling up, moving back in with parents, doing whatever they need to do in order to not have to pay these rents. Knowing what I know about Montgomery, Alabama, these are some pretty high rents for this area. So that said, let's see what the C's are telling us and see if the C's follow this trend, or if we see rent increases in all 4 quarters with negative absorption in all 4 quarters, which we've seen in a lot of markets in the Sun Belt. So let's go take a look at the C's. So here is our Class C rent analytic data. There are 126 properties totaling 10,361 units. For effective rent, we started the first quarter of 2022 at 760, went up to 773, up to 784, and then down to 775. So downtrend starting to happen, much like we saw with Tallahassee. So a little bit different of a trend than we see most Class C markets, where the fourth quarter is showing a down versus an increase like we've seen everywhere else. So Tallahassee and Montgomery are looking very similar. So let's look at our absorption, because there won't be any deliveries in the Class C space. And as suspected, negative absorption all the way across the board. We're now at 85.8% occupancy, well below the long-term occupancy average. So I would definitely call the Class C market in Montgomery in recession. A's and B's sitting right on that. As a matter of fact, A's were a little above the long-term occupancy average. B's were right on or slightly below that long-term occupancy average. C's well below the long-term occupancy average. So this market is definitely trying to force its way into recession, but it's not surprising for Montgomery because Montgomery lagged the rest of the state. When Mobile was getting investment, 2013, 14, 15, 16, 17, Birmingham was getting investment. Huntsville was getting investment. Montgomery was not. Montgomery did not start getting investments until about 2018, 2019, and it never really caught up to itself. There weren't a whole lot of properties developed, some in the downtown area, not any really in any of the suburbs. So, like the rest of the properties that we're seeing or rest of the markets that we're seeing in the Sun Belt, it is confirmed that this market is heading towards recession. The C's are definitely trying to pull it there. The A's are trying to keep it on the long-term occupancy average, with the B's starting to fall slightly below that long-term occupancy average. So that concludes Montgomery, Alabama. Be very, very careful in this market. Again, this is more of a lower income type market because it is the capital of Alabama and it's mostly government jobs. There isn't a whole lot of industry in Montgomery. Stay tuned tomorrow for another student market where we go to Columbus, Ohio. I will see you guys tomorrow.